Good afternoon, ladies and gentlemen, and welcome to the Wilmington PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and I'm sure the company will be most grateful for your participation. I'd like to hand over to CEO Mark Milner. Good afternoon.
Good afternoon. Thank you for the introduction. And good afternoon, or depending on where you are in the world, good morning to those joining. My name is Mark Milner. I'm the CEO. Alongside me here, we have Guy Milward, who is our CFO. And we're talking about the financial period for us, which is the first half of our trading year, which runs from the period from July to December 2024. We'll refer to this throughout the presentation as H1 FY25. The reason for the date of the pack is this pack was released on this Monday. So if I can turn your attention, please, to slide 2 for the safe harbour statement, and then on to page 3 for the agenda. We're going to keep this relatively straightforward. I'll just do a single slide about the headlines and cover those off. Then I hand over to Guy, who'll run through more of the detail around the financials. And then it's back to me again for the operational review and outlook. And then, as you just heard, we'll be ready to take your questions. So if you are following in your own pack, then we're going to be on page 5 for the headlines. Wilmington has had another good period of growth with ongoing revenue growth of 16%. The quality of our revenues continues to improve, with annual recurring revenue up 6% to 38%. And repeatable revenues are held at 72%. Remaining on the quality of revenues theme, our ongoing operating margin is up to 28%, and ongoing adjusted PBT is 39%. We continue to be good guardians of our investors' capital with a robust balance sheet and net cash as of the 31st of December 2024 of £31.3 million. The positivity shown in our numbers and the confidence in our strategy leads the board to offer an interim dividend of 3.0 pence. We have been successful with our M&A strategy, maintaining our discipline, and we attracted Phoenix Health and Safety to choose Wilmington as their preferred partner for the next phase of their growth. So, in summary for this slide, we have delivered another strong set of results, and I'll pass the Guy to give you the detail of the financials.
Thanks, Mark. Moving on in your packs to slide 7 to start with. We our normal investor packs, which you might have seen on our website. This one's on the website if you haven't been able to get it any other way for today. Our normal investor packs have three financial slides. One that talks about divisional splits of revenue and sometimes profitability. There's a full income statement on the next slide, and then a cash flow on the third slide. So those are the slides I'm going to run through today, and I'm going to start here on the slide headed operating review, which really talks about the revenue split in the way that we've been talking about it for the last year or so. You may have seen in earlier slides we used to split the revenues between training and intelligence. We then sold off most of the intelligence division, so that split was no longer valid, and this is the split we use today. Starting with the revenue running down section by section. HSE is the new section for us. This is a section, health, safety and environment, that holds the 2 acquisitions that we've done in the last 14 months. Astutis was bought in November 2023, and Phoenix was bought in October 2024. Astutis therefore has 1 month of revenues in the prior period. Phoenix doesn't have any, and Phoenix only has 2 months of revenue in the current period. So the numbers are obviously not comparable, and we're not going to say anything about a variance of 1,000% between the numbers. But we are going to say that both those businesses are, if you had the like-for-like numbers period on period, are growing in double digits. Astutis, the first acquisition, is growing at about 15% per annum and has been doing since we've owned it in the 14 months we've had it. And Phoenix is growing at about 25% currently for the 3 months we've had it, and has actually been doing that for some time now and is expected to do that for the rest of this year. So we've bought higher growth businesses than we previously had in the group, and we've sold some lower growth businesses. I'll come on to the margins in a minute, but we've also basically replaced lower margin businesses with higher margin businesses, which is why we're seeing the margins that we get today. The legal sector on here includes two businesses that have been with the group for some time. One called Pendragon, which is in the UK pension sector. That business and most of its customers are law firms, which is why we put it in the legal sector. That business grew at 4% in the period. It's largely a subscription-based business, and it has very high retention of clients. 99% is its usual number, and it's 99% in the period that we've just had. The Bond Solon legal training business, whose customers are mainly law firms, is also in the legal sector here. That revenue has gone backwards in the period, which gives us the overall organic negative variance on here. That revenue's gone backwards by 10%. The prior period had a couple of contracts in it that haven't been repeated in the current period. However, those contracts were not of a particularly high level of profit, and actually the profits of Bond Solon in this period have gone up despite the fact their revenues have gone down. So overall, the legal sector has had a very good profitability that has improved in the time. Those contracts that haven't been repeated may well come back. They just haven't come back in the 6-month period that we've had. They're more public sector biased and therefore are more likely to happen after April than this side of April. But nevertheless, that business has got improved profitability, and if you look at its revenues excluding the two contracts, is growing at about 11% per annum. So generally its underlying trend is upwards, and it's just got a difficult comparative in this period. Financial services insurance includes two businesses, one called Axco, which is in the global insurance data market. That business has grown at 6% during the period, and has again a lot of subscription revenue and has got a 99% retention rate, just like Pendragon has. The other business in this sector is called FRA. It's in the US healthcare insurance market. That business its revenues have gone backwards in the period. There's a lot of turbulence in its market. Mark is going to talk about that on a later slide in a lot more detail, but for the finance slides, it's just gone backwards in the period. Financial services other includes our two biggest businesses. One is called Mercia in the accountancy training space. That business grew at 11% in the period. And the other large business in here is called ICA. It's the largest business that we have. It trains in a number of financial services sectors, but primarily retail banking, and its revenues have grown at 8% in the period. So overall, our larger businesses have grown very positively, and our new businesses have grown very positively. Gives us an overall positive organic variance, albeit a couple of the businesses have had a more difficult period. That positive revenue experience in the period has helped our profits, as well as things we're doing on our costs and our technology investment, and our margins are up in the period. You can see here the ongoing margin, which includes the businesses we've bought as well as the businesses we already had, has gone up to 28%, and our organic margin, which excludes the acquisitions, is now up at 30%, which has been a long-term target for us. You can see because the ongoing margin, is slightly lower than the organic margin, that the businesses we've bought are doing a slightly lower margin than the rest of the business. They're both trading at about 25% operating margin, but we expect that margin to improve as their revenues improve going forward. There's not a lot of extra cost that needs to be added into those businesses, and when they're moved onto our technology platform, they will get savings in costs that will come through and give us a higher overall level of profitability. So 30% is an expected ongoing margin for the group, and is actually a margin we also think we can improve on over the next 2 or 3 years because of technology investments that we're making. which are reducing our legacy technology cost, which is still quite high within the group. We have been doing this for a couple of years, and we've already achieved some of those savings, but we have more savings that we can get. And over the next 2 or 3 years, as we move to a more single platform, rather than the different technology stacks we previously had in the various businesses, we're going to see that organic margin improve. A couple of other things further down the P&L to mention. One is that is the adjusting items number there, because it's a very big number in this period. Those items are largely to do with M&A, and in fact, most of the number in there is actually accruals for earnouts. So on the 2 acquisitions we've made, we have earnouts that require the sellers to remain as employees of the group for the period of the earnout, and because of that, the accounting standards require that those earnouts are put through the P&L as they're still costs of investment, but they're treated in the P&L essentially as employment costs. And therefore, you get a P&L charge for them here, and the cost of the acquisition doesn't go, or that part of it doesn't go on the balance sheet. But so that's something that's going to continue for the next 2 or 3 years as those earnouts play out and are decided. But you're going to see a charge below the line for those. It's a cash cost, but it's not an operating cost. It's a capital cost of acquiring those businesses. And the other point I wanted to make on the P&L was our tax charge. Because of the adjusting items, which are not deductible for tax, the tax charge as a percentage of total profit before tax is quite high. It's actually only 25% as an underlying rate. We make most of our profits certainly in the first half of the year in the UK, so we pay the UK corporation tax rate. You'll see that rate go up slightly for the second half and for the full year, because our US business in the healthcare insurance market is profitable and actually has most of its revenues in the second half of the year, and therefore we get a slightly higher tax rate, because the US federal taxes are about 28% at the moment. So last year we had an underlying tax rate of 27%, and that's the expectation for this year as a whole when we get to the end of the year. The dividends, 3 pence for the period's been held while we see how profits for the second half of the year come out. Over the last 3 or 4 years, we've been increasing the dividend in line with profits, and we would generally expect to do that, and we will probably do that at the year end. But at the moment, we just want to see how the US healthcare business in particular comes through the second half. As I say, Mark will talk about that in another slide in a minute. And then finally on to the final number slide for today, the group cash flow. This is a business that has generally converted all of its profits to cash. So we have a 100% plus conversion rate every year. That's split first half, second half. We get an outflow of working capital in the first half and an inflow in the second half. And this year is no different. Due to payment timings, the cash conversion of profits in the first half is a little bit lower than last year, but it's going to all come back in the second half. And indeed, as we sit here in the middle of February, already has. The reason for that is that we do a lot of our subscription billing on a calendar basis. So it's done in January and we collect the cash in February and March. And obviously that's in the second half of the year. And so a lot of our cash receipts from revenue come in the second half of the year. And as we sit here today, we're looking at a bank balance of almost £40 million. So we're already nearly £10 million ahead of the December number, and that will improve as we collect more cash from now until the end of June. And so the forecast numbers that are out there for us around 45 to 50 million for the year end cash balance. Couple of other things to say on the cash flow. We don't spend very much on capital expenditure of any kind. You can see that the expenditure in the period was 0. In the previous period, it was actually an inflow, and that's because we sold a building. But generally, we do spend quite a lot of money on technology, but it's all as an operating cost, because the technology that we buy is off the shelf. We don't develop it ourselves. And we therefore pay for it as we go as a user, just in the same way as you would pay for a Microsoft license as a member of the public, we buy our software in that way, and we don't spend therefore a lot of capex on it, but we get good off the shelf technology, and we put it together. Mark has got a slide on this a bit later on, but generally you won't see any numbers for that in our cash flow going forward. And then the big outflow in the period, obviously the acquisition, it's there shown net of cash received with the business, and is the costs of the acquisition. They go through the adjusting line underneath that, just as they do in the P&L. Final point to make is on the lease liability here. You can see it's a substantial reduction. With some of the businesses that we disposed of, we no longer need a large London office. It was costing us about £2.5 million a year. We've moved to a much smaller office for the businesses that we have that remain in London. That's given us an annual saving of about £2 million in both cash and profit. And you can see the lease liabilities have gone down by 2/3 because of that. And that's obviously going to come through in future lower cash flows, outflows, that is, and in future lower rent in the P&L. So it's another positive impact of the businesses that we've sold. Leaves us with a cash balance of just over 30 million at the end of December, moving towards the 50 I mentioned at the year end. We also have access to bank facilities that we're not currently paying for those facilities, but we know we can go and borrow certainly up to 2 times EBITDA, so about 60 million, giving us more than 100 million pounds available to spend on acquisitions if and when we find the right ones to buy. And we'll talk about what we would like to buy on a later slide, but at the moment it's our intention to spend that cash on further acquisitions. And with that, Mark, I'll pass back to you.
Okay, thanks, Guy. We're going to move on to then the operation review and outlook, on to, if you're following in your impacts, excuse me, slide 11. As Guy just showed you, overall as a group, we've had a really good first half to FY25. And this is continuing what's become a consistent trend. I'm not sure how long some of you have been following us, but we've been looking to grow the group year on year. And this is our 5th consecutive period of reporting revenue and profit growth. In total, out of our portfolio businesses, 7 out of the 9 businesses grew year on year in the first half, and 3 of them achieved double-digit growth, and 1 frustratingly short, just slightly off double-digit growth. We are, of course, not immune, though, to the external factors and influences which may change dynamics in our marketplaces. And I'll talk more about some of these in a few moments. But overall, if you want the sort of the larger picture, we've grown the portfolio both organically and at an ongoing level. I think this is an important point, not one to be glossed over. It's the strength of our portfolio means that when one of our businesses experiences an external disruption, such as we've seen in the US healthcare sector, we've demonstrated that we have the capacity to cover the impact. And in addition, we can then layer on top of this inorganic growth onto what is now a very solid organic core. And we've done that through the acquired businesses that we've brought into the group. I've just mentioned our US events company, that's called FRA. It's being impacted by US government and regulatory change, and now there's a degree of post-election activity as well. So we flagged the regulatory change impact in September, as this is actually a continuation of a challenge that we saw in the final quarter of our last trading year. I have a slide on this in a few moments, so we'll return to it very shortly. The other business which didn't grow year on year, as Guy's already told you, is in the legal space. It's called Bond Solon. It had a very successful FY24. It had those 2 contracts that Guy referenced that didn't renew in this year. And I think it is worth pointing out that if you take those 2 contracts out and you look at the underlying trend within Bond Solon, as Guy's already told you, we delivered 11% underlying growth. And this business just has a tough comparator, but certainly we're very pleased with the underlying picture. Within the 7 growth businesses, I include our 2 acquisitions. They're Astutis and Phoenix. Astutis is delivering to the acquisition investment plan. It was acquired in November of 2023, and it's achieving double-digit growth, as is Phoenix. Phoenix is brand new to the group, acquired at the end of October, and we actually have 3 slides in this pack, and I'll just introduce the business to you and explain it to you. At the same time, though, realizing we may not have spoken to you in the past, I'll also just build Astutis into that picture as well. There's a little bit of information which you may not know about us, but I've been in my role for 5.5 years, Guy around about 4.5 years or so. And when I joined 5.5 years ago, there were 15 businesses within our portfolio. And what we have done is an exercise of reviewing all of the businesses within the group, creating a central strategy, and then assessing the businesses against those strategy. I can just see some of the questions coming through. So as we've been reshaping, we've gone through a period of some disposals, and obviously, as you already know, we have had the two acquisitions. And FY24 was our last year was a particularly busy year for us with regards to reshaping the group. There is one remaining business within the portfolio which is held for sale. It's called Compliance Week, and it's a publishing media company based in Boston in the US. And we are looking to sell that business. We can say to you today that we've received good interest in that, and we are confident that business will be leaving the group during this second half of our financial year. At an operational level, we continue to invest in product development and technology, which I'll come back to later. And lastly, for this slide, we've advanced our AI activities. We normally do a slide in our investor briefings around how we see AI. We haven't done on this presentation. If you would like me to cover it, please do put something in the Q&A section. But broadly, what we're doing is we're taking external AI and then applying it to our products and services and using it to help us build products, but also looking for it in terms of internal efficiencies as well. So if we move on then in our decks onto the following slide, onto slide 12, I just would like to take a few moments just to talk to you about our portfolio management activity. I've already referenced we had 15 businesses when I arrived in the group, and now we have, I think 7 of those retained with 2 additional businesses. The portfolio management activity for us is all around strengthening the portfolio and then improving the quality of the assets and realigning the portfolio around a singular focus, which for us is the governance, risk and compliance space. Just to explain that, for us, a governance, risk and compliance has multiple different definitions. For us, it is working with customers who themselves are directly impacted by regulation. It could be a number of different verticals, which I'm about to show you, but that direct influence of a regulator with a customer and our relationship with that customer means that we can help them tackle those regulatory needs. And we do so by providing the services you see on this chart. On the left-hand side are mainly data and intelligence subscription type services. And on the right-hand side, we've grouped together some of our training activities, and we also run a series of events. And the training is split into 2. There is the continued professional development side of things, and then there's also accreditation. People study with us through certificate, advanced certificate, all the way up to master's level in some cases, to get really specialist qualifications in certain areas, certain regulated areas. The way we show the group is on the next slide, which is busy, but I will talk you through it. This slide shows, if you read it from the top down, it is we're in the governance, risk and compliance space. We're then in 3 verticals, which is the financial services, the legal and the health and safety and ESG space. And then the next line down are the markets where we operate. This is where, if we group our larger customer groups together, this is what it looks like. We're in insurance, we're in banking and lending, accountancy, and then you can read across the rest of that line. You pause then and then go to the left-hand side of the slide, you'll see what we do. We provide bespoke intelligence, subscription data services, regulatory intelligence alerts, and the other areas. And then what we do on this chart is plot on the logos of our brands and our businesses, so you can see where they're positioned. Now, we don't have the time on this call for me to run through all 9 businesses and explain what each one does, but this chart should hopefully answer some of your questions in terms of which sectors we're in and which brands are applicable. You will see the initial CW there, that's the Compliance Week business I just mentioned, which is being held for sale. But then you can see where the other businesses across the group, where they fall. The color coding here is designed to show you where we have most activity. This is not a market share chart. This is where is our core focus and where is the most area of activity for us. The darker the color, effectively the more active we have been historically. The mid-color areas are areas we are moving into, and the very pale areas on this slide are areas where we will come to at some point in time. So there's a number of points to make about this chart. The first off, that every business on this slide has a market share and share of wallet opportunity, bar one which has pretty high market share. But on the whole, across the group, we can grow our revenues organically by effectively increasing our share of wallet. That is asking our customers to pay more for additional products and services and putting through price increases. And secondly, we can go through market share, where we can go and reach new customers in the existing markets we're in. The other point to make on here, this also acts as an M&A chart. So when we're looking at our inorganic activity, we can overlay into all of these areas additional businesses which we can bring into the group through our internal dedicated M&A team. It's a team of effectively 3 people who are focused with looking for opportunities we can bring into the group. And the last area I wanted to point out is on the right-hand side, which I've labeled area 2. If you look at this chart, and we've used this chart for a few years now, if you look at it and go back a couple of years, or certainly more than 14 months, this health and safety area is brand new to Wilmington. We weren't in this market 14 months ago, but we looked at regulated marketplaces. We looked at where data and training was being delivered to customers who themselves were directly being regulated. And we found the health and safety ESG market, and managed to acquire Stutis in that space, and Phoenix most recently, and I'll explain Phoenix in a few slides. So where you see the plus sign on the right-hand side, that's indicating that we are looking for further areas we can move into, more verticals where governance, risk and compliance is very active and there is strong regulation in place. And we're looking to provide the services down the left-hand side into new markets and new verticals. So I hope that explains the chart. I'm going to bring you back to the left-hand side of it, where you'll see the number 1 and the sort of dotted line, and that's the business in the US healthcare space called FRA. It is, you can see from here, it's in the training and events space, and it's based in the insurance market. And the next slide just helps me explain this business. Now, just to remind you of our 9 businesses, and 7 of the businesses grew. The 2 that didn't, one of those was Bond Solon. It was on that chart, and that only didn't grow because of these contracts from last year, which didn't renew into this year. And then the second business we mentioned was in the US healthcare space, and it's this business I'm about to talk about. I'm going to assume we're not all experts in the US healthcare system, and I don't intend to give you a tutorial on that, but I will explain to you the part of the market that we're in, which is on the left-hand side of this slide, and we are in what's called the Medicare space. Medicare is as you can read from the slide, is a federally provided insurance program for those people over 65 or under 65 with certain conditions such as a disability or end-stage renal disease. It's made up of 3 parts, which you can see here, labeled A, B, and D, as shown on the slide. But the market also has a private company element labeled Part C, which is called Medicare Advantage, which is an upgrade on the original Medicare plans. And this is regulated by the Centers for Medicare and Medicaid Services, or the CMS. If you want the detail, it's on the bottom left of the slide. And there's an additional influence from the Office of the Inspector General, called the OIG, and the US Department of Justice, which is the DOJ. I should mention that the CMS is part of the overall United States Department of Health and Human Services. So in order of, that is the department covering all health services across the US. So you think of the CMS being a component part of HHS. So I'm going to move on to the right-hand side of the slide. And towards the end of our last financial year, so FY24, the CMS amended payment methodology, inclusive of coding changes, which resulted in reduced payments to insurance plans. Alongside this, the CMS and OIG were both very active in auditing plans and making claims for improper payments. Some of these reviews then resulted in a number of legal cases which were initiated by the Department of Justice, the DOJ. So the cost of implementing these regulated changes impacted our customers' marketing budgets, which in turn has impacted the number of delegates they can send to our events. And this business is exclusively an events business in the US, and exclusively in the US. Now, if you saw our packs from last September for our prelims, as of Q4 and FY24, we'd seen the number of delegates on a booking group be lower than in the previous year. Now, let me just explain that for a second. If you are a health plan and you are sending people to our events to hear from the regulators around the changes of regulations, to talk to suppliers and consultants and your peer group to an extent around that change of regulation, you would normally do so by sending a team of people to that event. But with the impact of the change of the regulation and also the other cost impacts that I've already mentioned, what has happened in the end of FY24 and throughout FY25 so far is that our customers have just sent less people in that group. So if the previous year they sent 10 people, maybe this year they've sent 9, or they're sending 8 people. We charge on 2 levels in this business. One is the sponsorship revenue we can generate, and secondly from the delegate revenue, and that delegate is a per person revenue. So therefore, if the number of people slightly falls, then our delegate revenue slightly falls as well. Now, what we've been doing here is to is to try to counteract that, and I'll talk about it in a second. In fact, no, I'll cover it off now, which is that the sales team we have, which is based in the US, therefore have to then go and make up that delegate list. So therefore we've expanded our program, and we've introduced many, many new companies to our products and our services, but we're not reaching the levels that we achieved in the whole of FY24. So 3 points to make about this slide. The first is, in addition, and this is the bottom right-hand side of the slide, there's been a change in political administration in the US, and the new head of the overall US Department of Health and Human Services is Robert F. Kennedy Jr., and alongside the president, if I can refer to Robert F. Kennedy Jr. as RFK Jr., alongside the president, has historically shown support for Medicare Advantage. Medicare Advantage is also favorably mentioned in Project 2025 initiative. As Medicare Advantage is larger than the original Medicare, it forms a significant role in the US healthcare system. There are 68 million people in the enrollment in the Medicare enrollment program. Over half of them take up the Medicare Advantage additional overlayer. If you look between 2023 and 2034 and you model through the demographic group coming through, there's a further 14 million more adults entitled to enroll in Medicare, and over half of these are expected to find their way into Medicare Advantage. So it's very much a growing market. And lastly, for this point, our customer referencing has been very positive about the quality and the relevance of our events, which leads us to have confidence that once stability returns to this market, our offering will become increasingly relevant. The second point to make is back to the wider group. I'd like to remind you of the strength of our portfolio. Over enough time, if you run a wide enough portfolio, most businesses are likely to see a degree of short-term disruption in the markets which they operate. And I think it's a measure of our strength of the portfolio that we can absorb these changes across the group. So even with the UK health disruption and the challenging comparison within Bond Solon, we have still delivered overall growth. And I think this reflects the far improved strength of Wilmington Group. And the last point here, the third point here, is with this improved organic core, we can now confidently layer on top revenues and profits from our new businesses, such as Astutis and Phoenix. So I just move on and just talk a little bit about Phoenix, the latest acquisition. It operates in the health and safety training market. And just to pick a few points off this slide, it operates out of Cannock, and those of you who know that's just slightly north of Birmingham. The business was founded in 2005, and you can read some of the stats across the top. It has 56 staff, and it trains a lot of people across a lot of countries. But dropping to the lower line, it has some really excellent long-term client relationships. It achieves above industry pass rates, which is really very important in this space. And it has a high volume of customers and learners, and it gets those learners are giving them a 4.9 star a Trustpilot review. That's out of 5, in case you're interested, and there are more reviews now from when this slide was put together. I skipped over this because I'm going to come back to a bit more detail on the slide. But if you wonder the sort of businesses that Phoenix is working with, here are just some of the logos, some of the brands that they work with. And then I'm going to move on to the next slide. Now we have, when we look at our own businesses, and there's a question here, I think this might answer it, around what do we look for in our businesses? What are the characteristics we look for in our business? And they are across the top here, numbered 1 to 6. So GRC focus, attractive markets, differentiated operating, and so on and so forth. And we have run all of our businesses against that and said, is this business in the GRC space? Is it in attractive markets? What is its differentiation, and so on and so forth. And that's led to a little bit of the disposal campaign that we've been running, and we're now coming to the end of, as we've looked at the businesses that Wilmington had acquired historically. Equally, though, we use the same matrix when we're looking at businesses to acquire. And there's a chart like this, looks very similar, in the results a year ago for Astutis. And what we do with our investors is we show them how the business we have bought meets the characteristics that we've set out. So just to pick out a few, and I've put some in bold here, just some of the key points rather than asking you to read an entire slide. If you go to column 1, the business is clearly in the GRC space, helping customers demonstrate their regulatory compliance and meet their legal safety requirements. And we do that by training, so a certification set by an external body called NEBOSH and IOSH and IEMA. They set the standard, they do the exams, we train up to that level. Businesses are increasingly required to show they are meeting those legal safety requirements. Column 2, it's a very attractive market in terms of size, and a growing demand and requirement for services. Column 3, Phoenix is similar to Astutis. Astutis also trains in the health and safety space, but they both share in common. They train to a very high quality, and they both have excellent ratings. Column 4, Phoenix delivers high margin double-digit growth, has a diversified client base. In other words, we're not reliant on a single relationship with a single customer. As you can see from this column, the top 20 customers account for only 15% of the FY23 revenue, that is. If I move on to column 5, the founder of the business, who is very much staying with the business and is an expert in the sector, is extremely commercial, has a very clear view of the future. And most recently, actually, in October of last year, was recognized from an award from LDC as one of the country's top 50 most ambitious business leaders. And lastly, one of the things we look for in our businesses is their ability to compete in the digital space, as well as obviously we do in this area, we do some face-to-face training. And you can see here that Phoenix is digitally very capable, meaning we say it's platform agnostic. That basically means that the consumer can choose how to use our product. If you want to turn up face-to-face, you can. If you want to do a virtual training, which is online with a trainer, you can. If you want to be completely online, then you can do that as well. But you can choose how you consume the products. Now, we will, in time, move this business into our areas of technology that Guy mentioned earlier. I'm just going to talk about that very briefly on this page here. What we've been doing is we've been bringing together all of our businesses, which were on individual technology stacks, if you go back into 2 or 3 years ago, and bringing them together onto a central technology platform. Now, the important part of that platform, as the guys already showed you, is we don't have a significant CapEx piece here because we're not building technology. Actually, what we're doing is we're plugging together technology. So, for example, we don't need to build an e-commerce solution. We can go and take one off the shelf, and that will serve as our e-commerce layer of our platform. Equally, when we're looking at websites, when we're looking at training management solutions, learning management solutions, the data layers and elsewhere, we don't want to build that 9 times across 9 businesses. We want to have a central technology stack across our group, and we're gradually moving to that point. And in the training space, this is called the digital hub. And the first business to move on there was one of our larger businesses called ICA. It trains compliance professionals predominantly in the retail banking space. Now has over 30,000 learners on that platform. And we work really closely with our customers. So there's a retail banking customer we can't name, but they have adopted this platform as their centrally managed regulatory and financial crime compliance training platform, and they're committed to do so over a 3-year contract. And then we're then, of course, rolling this out onto other partners, and you can see tranches of 500 to 600 learners coming through. So that's the central technology hub, let's call it, within the training area. And then we build additional products on top of that. And you can see here a RegTech solution effectively looks at learners' behavior and then provides information back at a management layer into our clients, who they can then use that for reporting of for regulatory purposes, for example. And that's what we've been asked to do by our customers, and that's in beta deployments. That's a new product which we rolled out to our existing customers and to new customers sometime in this half year, so before the end of this financial year. And that's a product upsell opportunity, as I said, the share of wallet opportunity I referenced earlier. And in addition to that, we've got a new AI regulatory alert solution. This is scanning for changes of regulation internationally, not just in the UK, and then presenting to you very much tailored results. And again, that information being pushed back through the digital hub. So we're effectively in creating our own platform and our own ecosystem. We could talk quite extensively about product development because that is a major feature of Wilmington. But I just wanted to give you a couple of examples here, just to give you a shape as to the way in which we view the technology activities and new product development activities across Wilmington. So onto the final slide, and it's a summary, and it tells you things we've already covered. But if I reflect on the first half of the year, it's been a very strong first half of the year. We've got 16% ongoing revenue growth. Ongoing operating margin is up to 28%. We've got 39% growth in ongoing adjusted profit before tax. We have our M&A team are all the time working with, normally talking to in the range of around 20 companies we've identified that we want to bring into the group, and then hopefully moving into a more detailed discussions with maybe 4 or 5 of those. And that's how we've got involved in the Phoenix acquisition. It significantly strengthens the portfolio, and it meets all of our characteristics, and we're very pleased with that business joining us, as we are Astutis the year before. Our technology continues to improve, and the digital hub adoption continues to be rolled out, and we've got the new product development I've just been talking about. And the strength of our portfolio positions us really well. And as we can, sitting here today, we can tell you that our trading is in line with our expectations moving forwards. So that brings to a close the sort of the presentation part of this session. It's time for us now to have a look at your questions and see how we can answer some of those.
That's great, Guy, Mark. Thank you very much indeed for your presentation, ladies and gentlemen. Please do continue to submit your questions just using the Q&A tab situated on the right-hand corner of the screen. But just while we give Mark and Guy a few moments just to review your questions submitted already, I'd just like to remind you, we're recording this presentation along with a copy of the slides, and the published Q&A will be available on the IMC platform. Mark, Guy, as you can see, you've had a number of questions from investors throughout your presentation. Firstly, thank you for your engagement this afternoon. If I may, guys, just hand back to you just to take us through the Q&A. If I could ask you to read out the questions, and then I'll pick up from you at the end.
Will do. Okay, Guy, I'll take the lead, and then I'll
Sure.
take questions on, and I'll allocate to you. So Ben, thank you for a couple of questions, actually. The questions are, how do we plan to accelerate the organic growth, and what's expected contribution from acquisitions in the coming periods? This is the first question. I'll do the first part of that, Guy.
Yep.
And leave the second part to yourself.
Sure.
I think if I go back to, and hopefully people can still see the slides, is that correct? Mark, is that correct? Yes, I'm thinking it is. I'm going to
Sorry, do apologise. Yes.
Yes, it is. Great, thank you. So I'm going to take you back to this slide and just show you the sort of the heat map type slide, and just remind you of what I said about the market share and share of wallet opportunity. All these businesses are working to 3-year plans. They each have, where you see a brand, with the exception of ICA and CLTI who work together, there are managing directors of each of these businesses, and their teams are focused on not just the short-term picture of this month's activity, but a 3-year plan activity. And therefore, we can say with confidence that we then, as a group, invest in those plans and have very much helped those businesses achieve them. And that's what's driving the organic core and the organic growth across our group. So yes, we have a very clear line of sight about our ambitions over the next sort of 1 to 3 years or so. But the delivery of those plans is undertaken by the specialist teams in each of these. Guy, over to you for the acquisition part of the question.
Sure. So the 2 acquisitions, if you annualize their revenues and profits, they're about 20 million at the moment. Phoenix 11, Astutis about 9, and a 25% operating margin on that 20 million. So about 5 million of profit is the expectation when we have a full year of both of them. So that's the contribution going forward, and then they're growing those numbers, particularly the revenue. So if we can get a combined growth rate of certainly high teens or maybe 20%, then you can see that number going up by that each year.
Okay, thanks, Guy. And then coming to the next question, Ben, thank you for this one as well. Also, the interim dividend remained at 3 pence despite strong profit growth. What factors influence this, and will there be an increase on the final dividend? I think we've covered that, Guy, but just want to do a quick refresh.
Sure. Yeah. So I take the point about strong profit growth, sort of somewhere up the P&L, operating profit, adjusted PBT. Actually, profits after tax, the amount you actually have to hand out as a dividend went down, and the EPS available to hand out is less than the dividend. So 2.88 pence against the 3p dividend that's been announced. That's part of the consideration, but we mainly wanted to take our time in considering what the total year dividend should be once we'd seen how the FRA business goes in the rest of this period in the next 4 months. Its biggest revenue months are March to June, and March in particular is its biggest revenue month. And so if it gets through that no more scathed than it currently has been, then we should have plenty of profit growth to pay an increased dividend at the year end. But at the moment, we were just hanging on that uncertainty and delaying the decision till we get to the year end.
Okay, thank you, Richard. Thank you for your question. Are there any underperforming assets that you are considered divesting? I think, excuse me a second. I wouldn't use the word underperforming, only because what we've gone through is looking at the strategic fit of businesses into Wilmington with a relatively new focus for us. As I say, this focus on GRC has only really been in the group sort of 4 or 5 years or so. A reminder, I've been here sort of 5.5 years. Previously, if I go back to the foundation of the company, we were a media company. We were a media business with a series of media entities, and therefore there we had a composition, quite a mixed composition in terms of the types of businesses, and we had some media entities within the group, and we decided we would move away from that space, move far more into the intelligence and data and training and education area, but entirely focused on GRC. And once that strategy piece had been worked on, tested, and then approved through our board, and then kind of communicate to investors, we've systematically gone through looking at each individual business. So the disposal process has been one of saying, does the business meet the strategy, the new strategy, or not? And some of those businesses were performing very strongly, but you have to align a group like ours around a central strategy. And if the businesses didn't fit, even if they are good performers, then we have moved those on. And that's been very much the active process in terms of our disposal campaign. And Compliance Week falls as part of that. It is a media entity. It publishes content around the predominantly US, but increasingly international, so compliance market. But it is a media business. It sells advertising and so on and so forth. And we're moving away from that into, as you can see, a very different direction of travel. So that is the case. There are no other media entities within our portfolio. Compliance Week was the last one. We did have I think 3 previously, so as we move away, we now focus on a different view of our portfolio, which is now performance based, and then we start to look at those 3-year plans and look at their opportunity to grow and the realistic opportunity for them to grow over that 3-year period. So that's very much how we now manage the portfolio. Very different strategy to previously, where we were sorting and organizing and focusing on a single strand of GRC. We're now looking at to build back up again through our M&A piece, but also ensure that our existing organic businesses continue to grow. I hope that answers your question. Tom, thank you for your question. Given the strength of the balance sheet, no dividend increase, are there plans to buy shares back? Guy, I'm going to pass that one to you.
It's something we always have in the capital allocation considerations. We have a large cash balance at the moment, and it will depend to a degree, I think, on whether some of the acquisition opportunities come quickly or not. But we have seen quite a lot of volatility in the share price in recent times. That if a buyback program had been in place, it might have helped. You get small amounts of shares on a regular basis that are offered for sale, and there isn't an immediate buyer, so the price goes down, and it's nothing to do with the results of the company or what the company's doing. It's just the trading in the market, and we are a particularly illiquid share, and that doesn't help sometimes. So buybacks are always something we're going to consider, and I think we would say at this point we'll keep you posted, but they're definitely on the agenda.
Okay, thank you. And then the last question I can see on here is from Peter. Would you say you are more focused on US expansion or acquisitions? I can give you the really short answer, that is no, but I need to explain it a little bit more. If I go back to the slide I was just showing you about the markets we're in, which was this slide here, which hopefully you're now seeing, a lot of these businesses, if you look at the Mercia business, it trains accountants, and they are in the UK. So that has a limited international expansion opportunity, given the very detailed nature that we're working in the UK. But if you go to Axco on the left-hand side, who sells data into the insurance area, predominantly in the underwriting area, that's covering 160 different geographic markets in detail, and probably 200 in total. So that's very much more of a global business. So our composition at the moment is quite interesting. We have businesses who have a big domestic market opportunity, and we have businesses who have that domestic plus an international opportunity as well. So when we're looking at our M&A, we tend to look at it from a market specifics, and we tend to look at where there is strong regulation in place. And where there is strong regulation in place, therefore, there is a requirement for customers to consume training and data or intelligence information sort of packages, then that's where we feel comfortable operating, because that's the core of the strategy I've been outlining to you today. And therefore, we tend to focus on those markets, those geographic markets where that regulation is stronger, enforceable, and so on and so forth. And that's what very much leads our international view. So that makes it very focused and very targeted. So we wouldn't specifically focus on the US, to your question. The US will be in our mix of areas we will look at. But if you looked at ICA, for example, we are specialists in the training around anti-money laundering into the financial services area, into the compliance teams in those areas. So we would look at where the regulations around that are really, really held, and then we would try and sell our products and services into those marketplaces. And in the process of doing that, we may discover some inorganic opportunities in terms of M&A opportunities. Okay, Douglas, thank you. I just posted a message. Guy, this is coming your way. How much growth can you add before central costs go up, both organic and acquisitions?
We don't think we need to add any central costs to add quite a lot of acquisitions. We've got the core team that we need to do one or two acquisitions a year for the foreseeable future, certainly 3 years out, and we wouldn't need to add any cost to do that. We don't see the central cost changing in that time period. So if we can add revenues and profits, then obviously the overall profitability of the group will go up a lot, because that central cost will become less of a drag on a bigger number.
Okay, thank you. And I think that brings to a close our session for today.
It does indeed, Mark. Thank you very much, Guy. Thank you also for taking the time to address all those questions, and thank you once again to everybody for your engagement. Mark, Guy, I know investor feedback will be particularly important to you both. I'll shortly redirect those on the call to give you their thoughts and perhaps expectations. But before doing so, if I may just ask you for a couple of closing comments.
Yes, I'm not going to, no more slides from us. I will make, actually, sorry, that's not true. There is a slide at the end which we haven't covered, and is an important slide, which is on slide 24. If you are interested in our positioning with regards to the activities we're undertaking in terms of our ESG activities and other areas, there is a slide here. We normally build it into the pack. A lot of progress, a lot of activity there, which is well worth reading this slide. And if you would like more detail on this, we would like to refer you to our annual report, where there is extensive coverage of all of these areas within the annual report we published last year. But then just bringing you back to this sort of the overall picture, rather than recapping on all the slides, I'd just like to thank you all for joining us today, and thank you for your interest in Wilmington.
That's great. Mark, Guy, thank you once again for updating investors. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. It'll take a couple of moments to complete, but I'm sure it'll be greatly valued by the company. On behalf of the management team of Wilmington PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.